Well, next Wednesday, the Bank of Canada will announce its next rate decision. My next guest says a slightly stronger inflation reading failed to shock markets on Tuesday, leaving the Loonie a little changed and pushing odds on an October rate cut back to about 70%. Let's get more now from Karl Schamotta, Chief Market Strategist at Corpay. Karl, thanks very much for joining us.
Absolutely. Great to see you.
Okay, let's get your thoughts on why you think it's going to continue in the direction you think it's heading.
Yeah, so we're in an interesting sort of interval here. On Monday, we had a very negative set of surveys, consumer and business surveys from the Bank of Canada. Basically, the underlying current in those surveys was that uncertainty is impacting investment activity, it's impacting hiring, and it's impacting buying activity, across the economy. And so this is really raising the risk of sort of downside for growth and unemployment in the months ahead. And that seems to be overwhelming the influence of inflation. So, yesterday's inflation print was slightly firmer than expected. We did see, a headline acceleration. Most of that came down to gasoline, but even under that, there were some worrying details. And yet markets are largely ignoring that. And I think this is essentially just down to that sort of asymmetry in the Bank of Canada's perceived sort of reaction function at this point. In other words, officials or policymakers are very much more focused on preventing further downside risk in the economy, as opposed to worrying about a potential, reheat and inflation pressure.
And are those worrying details you just mentioned, that reheat, and what's giving the market's confidence to ignore them?
Yeah, I think basically what the reheat is coming from is, sort of tariff-related hits. The fact that Canada had retaliatory tariffs in place did put some pressure on food prices. At the same time, you have other dislocations happening across the global economy that are acting on certain categories that, don't necessarily represent the underlying trend for inflation. And so, if we really look down below all those sort of, worrying details, and we look at the old measures of core inflation. So we used to focus on inflation that excluded food and energy prices and excluded some of the most volatile categories. And if you look at those measures, they are well within the Bank of Canada's range. So, it does not look as if we are, we're really at risk of an overheat right now. And if anything, the weakening demand situation in Canada, in other words, businesses and consumers spending less, could put downward pressure on a number of price categories, particularly in the services sector. And so, I think for the Bank of Canada right now, they're going to be more inclined to provide more accommodation to the Canadian economy, whether it's in October or December, as opposed to sort of staying on hold in the expectation that inflation pressures are going to continue to escalate.
Okay, and let's talk a little bit about the dollar. Where does this leave the dollar right now, then?
Yeah, Canadian dollar is really interesting right now. It's been staying very, very stable for a couple of days here. Basically, no reaction to that inflation print. Very little reaction to what those surveys said on Monday. And even though we did see that sort of precipitous drop in Canadian equity markets yesterday as the gold price tumbled, that did not really translate through into the Canadian dollar. And so the main reason for that is just that we're in sort of a technical trading range. Traders are looking at several key psychological levels. They're not willing to push things past that unless we see something major out of the U.S. And so, I think a lot of the tension here is around what markets are going to do on a global basis. In other words, are we going to see this extraordinarily fragile situation in equity markets and commodity markets eventually fall apart? And, what are we going to do, or what are we going to see when the shutdown ends and we begin to see, more data coming out of the U.S. economy? And I think, the sort of a foreshadowing foreshadowing of that is going to come Friday when we get the September inflation report out of the U.S. There's a lot of tension, a lot of speculation, a lot of stress sort of building up around that release, and it could very much, determine what people think the Fed is going to do next year. And if that, translates into, a big move in the dollar and into a big move in interest rates, then the Canadian dollar could break out of the range that it's in right now. But for now, there's nothing, on the horizon that threatens to push it in either direction.
And what about any kind of a tariff deal between Canada and the U.S.? What kind of an impact that might have? We've heard talk of that. What kind of an impact might that have on the dollar?
Yeah, I think on balance, it could be positive. I think if we read the tea leaves right now, if you read LeBlanc's interview there yesterday, for example, the tea leaves would suggest that we're not looking at a deal happening in the next week or two. There was, a sort of, how shall I put it, an off-the-cuff comment from Carney yesterday in which he sort of seemed to suggest that it was possible next week. But I don't think that that's actually going to happen. And so, if it were to happen, it would be seen as, providing some clarity for the Canadian economy. It would reduce that level of uncertainty that is paralyzing activity. But, the devil could be in the details. If Canada fails to negotiate, a deal on its own terms, something that's relatively negative, then that could translate into further downside for the loonie. But yeah, so on balance, the reality here is that the initial reaction to a trade deal would be positive, but traders would very, very quickly look below the headline at what had been negotiated, and that would determine the direction of the currency.
And I know we're always looking south when it comes to the dollar, but are there other outside forces that you're keeping an eye on?
Yeah, I think the big deal here, I think, in global markets is that fragility, right? The fact that some of these asset prices have risen so much this year, whether we're talking about artificial intelligence, just overall stock indices, gold, Bitcoin, et cetera. It does look to me as if we are all very much crowded into some very simple trades. And that at this moment, a lot of the investors out there, a lot of the speculators, the big money, investors, and some of the fast money folks as well are looking for the exits. They're thinking about, where do we go if we have a shock that destabilizes this sort of rapid appreciation that we've had. And so, the interesting thing, I think, is that we could be in a period of relatively suppressed volatility that ends in tears, right? That ends in a cycle in which everyone's running for the safe havens out there, which, historically have been the US dollar, Japanese yen, Swiss franc, and everything else falls. And so I think there's a lot of concern here, as to how sustainable the underlying trend is and where we might go if it does fall apart.
Okay, Karl, thank you very much for joining us today.
Thank you. Great talking to you.
And you, Karl Schamotta is Chief Market Strategist at Corpay.